Hey everyone, welcome back to Corporate Decoder. Today, the One Group Hospitality Incorporated ticker Stace just filed its quarterly report, and I am seeing some interesting shifts in their business. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is showing a comeback in profitability, but is still facing challenges with its restaurant portfolio. So this is the One Group Hospitality Incorporated's quarterly report for the period ending the 28th of June 2026. It gives us a look under the hood at how the company is doing financially. Let's dive straight into the balance sheet. As of the 28th of June 2026, total assets were about $885 million. That is pretty close to where they were at the end of 2025. On the liabilities side, current liabilities are at $124 million. Looking back to December 2025, they were a bit higher at $133 million. So they've managed to trim down some short-term obligations. Now here is something that stands out. Their series of preferred stock is a significant chunk of their capital structure at over $210 million. It is important to note this is a complex instrument with compounding dividends that increase over time. This essentially means the company owes more on this preferred stock as time goes on. And for stockholders overall, things are still in a deficit at a little over $92 million. This means that if the company were to liquidate today, there wouldn't be enough assets to cover all its liabilities and preferred stock obligations. Moving over to the income statement for the 3 periods ending the 28th of June 2026, total revenues were just over $200 million. This is down slightly from about $207 million in the same period last year. The bulk of this revenue comes from their owned restaurants at $197 million. While it is a small decrease from last year, it shows they are maintaining a strong base. On the cost side, owned restaurant operating expenses were about $126 million. This is a slight decrease from last year's $129 million, indicating some efficiency gains, or perhaps a reduction in operations due to restaurant closures. The good news here is operating income jumped significantly. For the 3 months ending the 28th of June 2026, it was $6.6 million up from just $0.7 million in the same period last year. This is a huge improvement. However, the company still reported a net loss of $2.1 million for the quarter. This is a big improvement from the $10.1 million loss last year, but it still shows they are not quite at a profit yet. Looking at the first 6 months of 2026, total revenues were $413 million, down slightly from $418 million in the first half of 2025. Operating income for the first 6 months of 2026 was $20.5 million, a substantial increase from $11.4 million in the same period last year. This suggests the business is becoming more efficient, and for the first half of 2026, the company actually reported a net income of $1.1 million. Compare that to a net loss of $9.1 million in the first half of 2025. This is a really positive sign of turning things around. The company operates several restaurant brands like STK, Benihana, Kona Grill, and RR. They've been working on optimizing their portfolio, which means closing or converting some underperforming locations, particularly in the grill concept segment. This strategy seems to be paying off in terms of efficiency. Their property and equipment are valued at around $283 million. This includes their buildings and improvements, and a good chunk is tied up in construction in progress, which means they are actively investing in new locations or renovations. Their intangible assets are valued at about $129 million. This largely consists of brand names like Benihana and Kona Grill, which are valuable assets in the restaurant industry. Long-term debt is a significant factor, standing at $347 million. While they did take on new borrowings under their credit agreement, they also made substantial repayments. The average interest rate on their debt is around 10.2%, which is quite high. This highlights the importance of managing their debt effectively. Specifically, they have a credit agreement that provides a $350 million senior secured term loan facility and a $40 million revolving credit facility. While they've reduced their borrowings on the revolving facility, the overall debt burden remains a key financial consideration. Looking at earnings per S-share, the trend is positive. For the 3 months ending June 2026, the net loss per common share was $0.36. This is a significant improvement from a $0.56 loss per S-share in the same period last year. For the 6-month period, they've moved from a loss of $0.76 per share to breaking even at $0.55 loss per S-share. This turnaround is a major highlight of this filing. The series of preferred stock continues to be a major factor impacting their financials. It was issued in 2024 for $160 million with a 5% original issuance discount. The preferred stock is compounding dividends that increase over time. This means the total amount owed on this preferred stock is growing and it is a substantial obligation. Stock-based compensation is about $1.1 million for the quarter and $2.3 million for the first 6 months of 2026. This is a standard expense for publicly traded companies to incentivize employees. The company breaks down its performance by segment STK Benihana and Grill Concepts. STK and Benihana appear to be the stronger performers in terms of restaurant operating profit. For the 3 months ending June 2026, STK-owned restaurants saw a revenue increase of 2.5%, and Benihana saw an increase of 0.8%. Grill Concepts owned restaurants, however, saw a decline of 14.6%. This clearly shows the challenges within that segment. Restaurant operating profit for the first 6 months of 2026 was $72.1 million, up from $66.7 million in the same period last year. This improvement is driven by better cost management and menu optimization. In their management discussion, they highlight a focus on capital efficient growth and plan to open 6 to 10 new venues in 2026. They've also been converting some underperforming Grill Concepts restaurants into more profitable Benihana or STK locations. Same-store sales for STK-owned restaurants improved to 2.5% in the first quarter of 2026 and 1.1% for the first 6 months. Benihana also saw positive same-store sales of 0.8% for the quarter and 0.4% year-to-date. Grill Concepts owned restaurants continue to struggle with negative same-store sales. Financially, the company generated $33 million in cash from operations in the first 6 months of 2026, a significant jump from $11.3 million in the same period last year. This is a strong indicator of improving operational health. Capital expenditures were $23 million, primarily for new restaurant construction. They are planning to open new STK and Benihana locations and convert existing ones. This shows a clear strategy of investing in their most promising brands. They do mention geopolitical instability and armed conflict involving Iran as a risk factor. This could impact global economic conditions and supply chains which are relevant to any business operating internationally. So what is the story here? The One Group Hospitality Incorporated is showing signs of a turnaround. They've improved operating income significantly and are now profitable on a net income basis for the first half of the year. Their core brands like STK and Benihana are performing well, and they are actively managing their portfolio by closing or converting underperforming restaurants. However, they still carry a substantial amount of debt, and the series of preferred stock is a notable financial overhang. The strategy of focusing on capital-efficient growth and leveraging their stronger brands seems to be the right path forward. The risk I am watching is how they manage the significant debt burden and the increasing obligations from their series of preferred stock. What I am actually looking for is continued consistent profitability and a clear path to reducing their overall liabilities. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Check out the Discord in the description.